This wasn't a mistake. For the past decade, American shale oil has been called a miracle. The technology that made America energy independent, the innovation that broke OPEC's stranglehold on global markets. But in 2019, the Wall Street Journal published an investigation that should have been front page news everywhere. Pioneer Natural Resources, one of the largest shale producers in America, had been systematically lying about well performance. Here's what they promised investors: wells that would produce 1.3 million barrels of oil over their lifetime. Here's what those wells actually produced: 482,000 barrels, one third of what they promised. This wasn't a mistake. This was fraud. Internal emails showed Pioneer's own engineers developed better predictive models that revealed the truth. Management ignored them. When asked why they didn't adopt the more accurate models, one engineer joked, "Because we own stock." In May of 2024, ExxonMobil acquired Pioneer for $60 billion, the largest petroleum merger in 20 years. Pioneer executive cashed out at the top. Exxon inherited a rapidly depleting asset. But Pioneer wasn't unique. This is the entire industry. Here's what the data shows. From 2016 to 2020, U.S. shale added 6 million barrels per day to global supply. It was explosive growth, but in 2025, production growth has slowed by 25% to just 250,000 to 300,000 barrels per day. He recently stated U.S. liquids production is expected to remain flat or fall slightly through 2026. Even the CEOs are admitting it now. Vicky Holub, CEO of Occidental Petroleum, said in 2025, between 2027 and 2030, it's likely that the U.S. will see peak production and after that some decline. Let that sink in. A major shale CEO is telling you peak U.S. production is 2 to 5 years away. Here's why. Shale wells are not like conventional oil wells. A shale well loses 70 to 80% of its production in the first 2 years. They are not wells, they are expensive sprints. And here's the critical fact. The industry has already drilled 60% of its Tier 1 acreage. That's the sweet spots, the best geology, the highest return location. What's left is Tier 2 and Tier 3 acreage that produces less oil, costs more to drill, and declines even faster. When the best operator in the industry can't grow production despite record cash flow, that tells you everything you need to know about the geology. The shale revolution is over.